Mean the definition of an actual bear market from the high to the low. The S&P 500 not quite yet in bear territory. However, the NASDAQ is certainly close with 2287.30 being the key number to watch on the NASDAQ. Whatever it is, it means a money loss for major bulls today. Dow Industrials down 65 points again. On top of that, 350-point sell-off yesterday. 11,388 last trade on the blue chip. NASDAQ looks like this. Again, more selling today. Technology being sold, financial services. Once again, the two leadership groups taking this market down as oil moves up yet again, well above that $140 a barrel level. S&P 500 down 3/4 of 1 point right now, Dylan.
Yeah, again, oil, the obvious story, but everything suffers hostage at 140 a barrel. Very hard for anything other than some of the inflation names, gold specifically, to advance. We send it around the horn. We'll begin with Mary Thompson right here on the floor. Hi, Mary.
Hey there, Dylan. You know, the markets did actually pair their losses as oil paired its gains going into the close of the New York session. And so we saw the Dow come off its lows of the day, and right now it stands off about 69 points. What we've also seen is the transportation average, which had been under some pressure midday. It's recovered. It is now up just about 20 points. And the Russell, of course, we're awaiting the rebalancing at the close today. Take a look at where it's trading right now, just about 14 points. This, of course, once a quarter, the Russell indices, stocks are added to these indices, but only once a year, this day, are the stocks taken out of these indices. So we're expecting a little bit of choppiness ahead of that. Let's take a look at the good, the bad, and the ugly on today's markets. The good includes, of course, the energy stocks and gold stocks like Exxon and American Barrick. They're moving to the upside, and drug stocks. Merck is the biggest percentage gainer in the Dow Jones Industrial Average thanks to positive phase 3 trials from a new migraine drug. It plans to actually apply for a new drug application next year. Pfizer going along with the ride with the rest of the drug stocks today. The bad include the financials. JP Morgan breaking through its March lows. Morgan Stanley under pressure because its rating is under review from Moody's, its long-term rating. And KB Homes came out with a much wider than expected second quarter loss. So that put pressure on the home builder as well as some others, including its rival Lennar. The ugly, actually, take a look at that. Sorry, Morgan Stanley's turned around. Maybe not so bad. Here's the ugly, though. Christopher & Banks, this is a women's apparel retailer, reporting earnings for the first quarter that were decent, but a warning on the second quarter because of expected slow demand, so that put pressure on its stock. Steelcase, a maker of office furniture, reported weaker than expected results for the prior quarter and then lowered its outlook for the current quarter. Again, weakness here in the U.S. It's been strong demand internationally, but not here domestically. And then American Eagle under pressure because its chief marketing officer and president is leaving. It's raised questions about whether or not the company has the right product mix going into the important back-to-school season. Now let's get a tech on check, and for that, of course, we go to Scott Wapner at the NASDAQ. Scott?
All right, Mary, thanks so much. We may be dangerously close to a bear market here at NASDAQ as well, but we're trying awfully hard to get back into positive territory. We're now down less than 5 points. We've been slowly, as you look here on the intraday chart, working our way back from the lows of the day that was set just before the 2 o'clock hour. So we'll have to see how things shake out over the last hour or so. It's really a comeback towards positive territory as the big cap technology stocks have turned around. They were weak throughout the day today as everything was weak. Google is now 1%. Intel's coming back towards the flat line. Microsoft touching positive territory, and even Apple shares now positive as well, ahead by 0.7%. Take a look at research in motion. What a tough week it's been. Obviously down 13-14% yesterday. It's still sitting down another 1.5% today off the lows of the day. It is worth pointing out here as you look at that 1 week chart of research in motion. Today's news, Credit Suisse has started coverage with an underperform rating. If there was a dose of bad news at the beginning of trading today, it was coming from Ericsson, which issued a profit warning. As a result, we were looking at the mobile phone stocks, the handsets, the chips, and stocks like that down 6% right now. They say gross margins are going to be hit. How about some story stocks? And hey, I got 3 positive ones for you. Novell is up 3%. Jeffries upgrading to buy from holds. Imclone is up 2.5%. OSI Pharmaceuticals is up 4.5%. Thomas Wiesel starting that with an overweight rating. Let's go to Sharon Epperson down at the NYMEX.
Another record day for oil, coming within just a penny of $143 a barrel. Officially, prices have not settled yet, but we are poised for another record close, and this is significant as it marks the second straight session that oil prices have broken out of that range that they were stuck in for the past 3 weeks. We paired some of the gains going into the close, which is why it's a question mark as to whether or not we're going to close firmly above that $140 mark. Another indication of why we are at these levels is that money seems to be flowing out of equities and into commodities, and especially oil. And why is this happening at this particular time? Well, it seems to be a pretty good deal if you look at what you can get for about $12,000. Looking at the margin requirements here, it offers quite a bit of leverage and a good reason for getting into the oil market. $12,000 investment right now, you could get $143 worth of crude. Your money goes up $12 to $155, and you have doubled your investment stake. So also taking a look, we're looking at 140.21, the settlement price right now for the price of crude. That is just settled, so it is officially another record close. Rick Santelli, over to you in Chicago.
Well, thank you. And today it's all about the yield curve, flight to safety, and the residuals of the Fed. You'll see what I mean. Look at intraday to two-year notes. It's been pointed out its yield's only down a bit from 266 yesterday, but it's down a boatload from 290 last week as you look at the 1 week chart. Now, 10 years today in 30s, look at intraday of 10s, they're down about 5-6 basis points, but they're down 19 on the week, getting closer to the 2-year, but the 2-year is still bigger. Even the 30-year, which was more worried about inflation, less about the Fed, is jumping on the flight to quality end of the quarter bandwagon. Its yield on the day is down about 7 basis points, and on the week it's also down about 19. So the variable to pay attention to is how these yields behave next week when the Fed is more of a constant and we see the residuals effects of the credit anxiety that has resurfaced. Maria, back to you.
All right, thanks so much. Meanwhile, billionaire investor Sam Zell says he's still optimistic about the U.S. economy. Zell telling CNBC today that the economy is not in and will not enter a recession, in his view, although he admits not seeing signs of strong growth, certainly in the real estate business. However, he does believe that negative talk from the media and politicians, he says, could lead to a self-fulfilling prophecy.
I don't think that the U.S. is anywhere near as weak as, if you read the newspapers, you might think. I think it was interesting that the CEO of Procter & Gamble yesterday admonished the political candidates to lay off the woe is me. I think that the political candidates are contributing to a lack of confidence. And I think we have more problem of confidence than almost anything else.
Zell added that he thinks the Federal Reserve will need to raise rates sooner rather than later unless inflation significantly moderates. By the way, earlier, the billionaire real estate mogul said that actually the Tribune Tower, home of the flagship newspaper he acquired, actually could be part of a broader sale so that he could cut down on that massive amount of debt he took on. Dylan, back to you.
All right, we all know energy, the centerpiece of every conversation, even if you'd prefer that it not be. I've got a couple of folks with me here on the set that I want to talk to about all of that, of course. Just give me 1 second here, Maria, to get things squared away here. I got one guest here. You're a new guest to me, so I don't remember your name, as a fact.
I'm Jason.
Jason, what's your last name?
Sue.
And where do you work, Jason? Because I have no
Based out of Pasadena, research affiliates.
All right, welcome. And it's, of course, nice to see you again. We know who you are. So, Jason, tell me real quick how you're dealing with a market that is in collapse, effectively, or at least in a precipitous decline.
Well, you know, we've been lucky. We stayed out of the way in terms of not having allocation to the equity market, and in some incidents have a short position. So this has actually been a fantastic situation for us. I hate to say that.
Stephen, your view, the average investor is in a long-only portfolio that is getting beaten this year. They have a couple of choices: ride it out, sell, and try and either get short or position with a more aggressive strategies like the ones that Jason's referring to, or try and accumulate some version of a hedge where they own what they own, but then also buy things that also go up in a down market, gold and some of the double short ETFs and that sort of thing. What do you think is the appropriate way to proceed?
I think for the average investor, there's a lot more questions than there are answers. So I think long-only investors, which would account for most of the market, I think this is a pretty poor time to be trying to time the market, which there's little evidence they can do successfully. And even if they could, locking in losses and moving into a small number of areas that have taken off probably doesn't seem like the best way to go right now. So this is the time when your 3, 5, 7, 10-year long strategic discipline pays off.
So you're saying accumulate assets through this, ride this out effectively.
Yeah, I would say that's where most people would look. And right now, assets are becoming more attractive than they would have last November. I think there's more bad news behind us, more write-downs behind us, and more bad information behind us than there is in front of us. But the tempered part of that perspective is while a lot of the bad news may well be behind us, I don't think that the economy or the markets are going to move briskly off of a bottom. So I think patience needs to be married with discipline in this environment.
Got it. And for the CEO take, we have Keith Smith, President and CEO of Boyd Gaming. Keith, are you seeing any impact, or I'm sure you're seeing some impact. What order of magnitude are you seeing on the not just gambling but travel tourism business at this point in the summer as a result of energy?
Well, we certainly have been impacted both here in Atlantic City and in Las Vegas and across the country. As the consumers have a few less dollars in their pocket to spend, we've seen an impact to our business.
If you were to look at the anticipated impact going forward, how would you describe it?
Well, we saw a significant impact in the first quarter in the neighborhood of 20%. And, we've been able to modify and refine the business so that we don't think we'll see that same level of impact to our business going forward. But once again, we have seen an impact. The consumer is in an uncertain place, has less discretionary income in their pocket, and that's what we count on.
If you were to look at your ability to manage some of these variables, in other words, how adaptable are you and how much can you manage not only the demand cycles but also your cost inputs?
Well, look, this is part of a cycle that the business goes through. We've been in business for a long time, and we've seen these cycles. We manage in the good times and we manage in the bad times. There is a high degree of variable expense in our business that we are able to manage through, whether it's payroll or certain other costs, and I think we're doing a good job at managing through those. But at the end of the day, we need to provide a quality level product, and quality sells. Quality always sells to the customer, so we have to maintain quality at the same time as we refine our costs.
Let me jump in here, Dylan, and really ask our market guests a question here. Jason Su and Stephen Wood, do you worry that now we're in bear market territory? Do you think that tells us anything about what's to come for the rest of the year, Stephen?
I think it does. And what we've been really witnessing, Marie, is this rolling credit bubble for the better part of a decade now. It went through technology, it went through housing, then structured investments and financials, and I think it's clearly evident, at least to a large degree, in commodities. So I would be very, very cautious about chasing that credit bubble cycle. And then also, earnings are going to be repriced, and I think assets are being repriced as we speak.
Jason, do you agree with that? And I guess, Jason, adding on to that question, I would say to you is, do you think we've seen this market experience the worst? I mean, can the market go higher even if financials don't go higher and they continue with the upset?
Maria, I think I agree with Stephen. We haven't seen the worst of it yet. Financial might have corrected in prices, but by and large, we haven't seen the rest of the other sectors have their price correction. So I am very worried. I agree with Stephen that consumption is going to slow, and it may slow fairly aggressively. What that means is you may see weaker numbers coming out from the retailers corresponding to the holiday seasons, and I think that's going to be a very pessimistic outlook come Q1.
You mentioned, Jason, that you had a number of things that were working for you in this context, both being short or long, I presume, things in the commodity arena that have been appreciating in value. Walk us through from here the assets, both long or short positions you have on going into the summer that you think are, that you're the most optimistic that will continue to serve you well.
Definitely. I think the one thing that we need to be focused on is, of course, rising inflation. I think that is the one thing that is here to stay. We have just seen a very long period of time where inflation hasn't been an issue, but I think that's about to change. So a good asset class for us to focus on would be tips or anything that's inflation protected. I think commodities gives you some of that too. But I think tips in terms of this new inflation protection fixed income asset class is something you really need to look at.
You're nodding, Stephen.
Yeah, and I think also something that would be more cautious in tone would be in the financial sectors. If we're looking at eventually a situation where financials will repair their balance sheets and they'll they'll reacquire the risk appetite. But are we going to be in a regulatory environment where they'll be allowed to finance risk-taking? Because right now, essentially, most players are playing with the house's money. They're tapping into the Fed's balance sheet. And Congress is obviously going to be in a mood, as will the SEC and the NASD, as well as Treasury, to make sure that risk is properly hedged and managed. So I think as risk vehicles become more attractive, I think this might slow down some of the financials move upward.
So let me jump in here with Keith Smith. Mr. Smith, I know that you're unveiling a new hotel. Tell us a little about that and really what kind of expectation you have, even in the midst of this economic slowdown. How's tourism from outside of the United States going? Are you seeing foreigners come in because of the weak dollar?
Well, thank you, Maria. I'm here in Atlantic City at the brand new Water Club Hotel. It's our newest addition here at the Borgata, a $400 million, 800-room hotel, something we're very, very proud of. Just had the grand opening celebration today, and we're very confident in the market here in Atlantic City. And